These are systematic trading firms that run on rules-based models. They don't care about news. They don't care about geopolitics. They just follow trends. When the trend is down, their algorithms say short. When the trend is up, their algorithms say long. It's mechanical trading. Goldman reported that CTAs were sitting on about a 30 billion net short position going into the ceasefire, but the second the S&P crossed certain trigger levels, these models flipped, and they didn't flip to neutral, they flipped to go long. Goldman originally estimated these CTAs would need to buy back around $40 billion of equities to exit their short positions. But the actual number ended up being $86 billion across just 5 trading sessions, which, according to Goldman's records, is a top 5 buying speed print of all time. And then there was the third domino to fall, the options market. Dealers on the other side of options trades have to stay delta neutral, which means when customers pile into calls, dealers hedge by buying the underlying stock. And Spot Gamma, a leading financial data platform, had flagged a negative gamma regime heading into the ceasefire. That's the regime where dealer hedging flips from stabilizing to pro-cyclical. Price goes up, dealers buy more, price goes up more. You get the point. So a squeeze, plus a systematic flip, plus dealer hedging. 3 dominoes, all falling one after another. That's the rally. That's what we saw. And here's the funny thing. This isn't the first time we've watched this movie. It's a very similar pattern that has played out again and again over the last decade. Because go back to December 2018, stocks had been crashing for months on fears of a rate hike. Then Jerome Powell goes on stage and says one word, patient, and the Dow explodes. It was the first time the Dow had ever gained more than 1,000 points in a single trading session. Or we can go to August 2024, when the Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began to unwind, which I've made a video about. Then the Nikkei drops 12% in a day, then bounces 10% the next. These are all different catalysts, but the same mechanisms. And the reason this keeps happening is that the structure of the stock market itself has changed. 20 years ago, the market was dominated by humans. Portfolio managers reading earnings reports, analysts modeling cash flows, people making discretionary decisions about what companies were actually worth. But now, that market is basically gone. Today, 63% of all US stock funds are now held by passive indexers. That's more than $13 trillion of blind money that doesn't read earnings reports or care if Apple had a good quarter. It just follows the index on autopilot. And because most passive funds are market cap weighted, the bigger a company gets, the more of it they buy, which is how the Magnificent Seven now makes up over 33% of the S&P 500. So a massive chunk of the market isn't being priced anymore. It's receiving allocation on default, and what's left of the active investing side has also changed. The hedge fund industry has consolidated into a handful of giant multi-strategy funds that dominate the industry. The Millenniums, the Citadels, and the .72s of the world, and their assets under management have grown exponentially over the last decade. These funds typically run at 4 to 8 times leverage with strict drawdown rules, which means when they hit a drawdown limit, they don't sit in a conference room and debate whether the Fed is going to cut or whether the war is really over. They sell immediately. And underneath all of this is the options market. Because now, same-day expiration options make up around 63% of all SPX trading. On peak days, we're seeing over $2 trillion of notional value change hands in a single trading session. Every one of those options forces a dealer on the other side to hedge in real time, which leads to buying or selling the underlying stock to keep their books balanced. So the dominant players in 2026 aren't analyzing valuations or fundamentals, they're reacting, and when price moves, their reactions stack on top of each other. And this is what happened on April 8th. Once you understand this, once you understand the mechanics behind why markets are irrational, everything starts to make a little more sense. So if you're tired of watching traditional financial media hand you the dumbed-down version of what's happening in markets, hit subscribe, because this is the stuff they conveniently forget to cover. Because the stock market we all used to know and love, the one about finding undervalued companies and investing in them for the long term, that stock market is gone. What's left is a giant feedback loop of algorithms, passive funds, and options dealers, all reacting to each other in real time. And the headlines? Well, they're just the narratives people use to help rationalize things.